Hello, friends. Welcome to the third part of Planning Personal Finances, and that is should be following Chapter 3. It's tax planning. I definitely want you to read this chapter. Tax planning involves a lot of legal advice, and that's not the purpose of this quick lecture. It's just an overview for those of us who have paid taxes for many years. You know it very well. For those of you who are just starting out and are going to pay taxes and not full-time employment, you may find it useful. But please consult your accountant. This is always a disclaimer. Consult your legal team if you want any hardcore advice here, okay? So, with that said, about a third of each dollar you earn goes to pay taxes. And I might even say, for the working person, maybe it's 40% because everything we purchase has a tax to it, doesn't it? Tax Freedom Day is somewhere in mid-April, and that just basically means for the first 3 months, maybe 3.5 months, most of our income goes to paying our taxes for the whole year. So we're paying 3 months and 15 days of taxes, and the rest of the time of the 12-month period, so that gives us about 9 months, we get to keep that money. Interesting to think about. Depressing to think about as well. Common goals, my friends. Why are we? This is a nice overview, but it's a very big part of our financial plan. The more money you make in your career and over your lifetime, you certainly want to know the pros and cons of reducing your tax balance. For any of us who are self-employed or have a side business, which I think is a great idea, pardon me, you will have some different tax rules to follow. So we want to keep the laws that affect us. We definitely want to complete an appropriate tax record. So again, get yourself possibly a nice file folder, maybe even the plastic ones that can be covered, and anything that relates to taxes, certainly the correspondences that you get from your employer, any investment accounts, you want to put that in there so at the end of the year you can be very organized and ready to do your taxes. So there's our decisions that can reduce our tax liability. And again, a little bit of planning goes a very long way in anything that you ever do in life. There's 4 basic types of taxes, and again, overview, I may be not hitting every single one, but the one that affects most Americans and most of us in this course are going to be sales tax. We live in the state of Texas. We are very fortunate. We're one of the few states left that does not have a state income tax. So the majority of our financing for the state, for Tarrant County College, and for everything else runs through sales taxes and property taxes. So we do have a rather high sales tax compared to other states, but again, we don't have that income tax, and we don't want that state income tax either. So yeah, the state gets 6.25% of every sale on a non-tax exempt item that goes into the coffers, and then the cities take about 2% for themselves. I should say the cities get a part and the counties get a part. It gets divvied up, but the state takes the biggest share there, the lion's share of 6.25%. If you own a home, you pay property tax. If you're living in an apartment, you're still paying property tax. It's just a part of your rent. You also have personal property tax, which means when you buy an automobile, a nice car, you get to go and pay about, I think it's 6% right now, to the state comptroller. Okay, you pay that at the county tax office, or your dealer, your car dealer will basically send that amount, but you're paying that. Any other large ticket items, motorcycles, boats, etc., will have that property tax on it too. Personal property, it's a one-time hit. Of course, the taxes on wealth. Estate tax, there's a federal tax right there, although it's very low. Does protect the very, very wealthy. And the state also has an inheritance tax, but you would have to have some pretty high numbers here to get that taxable on you. And of course, here we go, the taxes on earnings. There's income tax, but if you are a college student and you see your income check, I'm sorry, your monthly check, you may see the FICA, the federal withholding, in your Social Security tax. That's a big one right there. That may be more for some people than income tax. Right now on Social Security tax, your employer, you personally pay about 7 to 7.25%, and then your employer pays another 7.25%. So it's a shared tax. If you have the luxury, and I say the option of being self-employed, you get to pay 15.25%, somewhere in that ballpark. Please do not quote me on the exact numbers, because you're paying your share and the employer's share. And if we could just reduce some of that, I think we would really spur small businesses into action. If we could just cut it down to half that, 7%, for like the first $200,000 worth of sales. So that's just my opinion, my soapbox. As someone who was self-employed, cutting that extra self-employment tax is not very fun. Cutting a check at the end of the year is a tough one. So there we are, our big area. So how can we, reduce some of these taxes, or at least be aware of what we have to pay? So let's look at the one that affects most of us. That is an earned income, okay? So earned income includes wages, salaries, your commission if you're in sales and you get those nice bonuses and commissions at the end of the year. Those are taxable. Any type of fees, attorney fees, you get the picture there. Tips, yes, for those of you who are in food service and are a waiter, waitress type of position, you can really make a lot of money on tips. And the federal government figured that out back in the 1980s. And because these were not taxable, most of it was in cash. And instead of trying to get very wealthy people to pay their taxes, we said, let's get the working person who lives on tips and make sure we tax that. So if you're in that type of business, I'm pretty sure that the IRS basically does a calculation of what your orders are per day, per week, per month, and says this is what taxes should be taken out to try to get through the underground cash in the pocket. Investment income, all right. Portfolio income, if you have stocks, you will get dividends, all right. That's taxable, especially when they're cash dividends. Interest from large bank accounts, all right. Rent from investments, basically any type of money that's coming off an investment within the United States at least, is going to be taxable. So there are some options right in there. There's municipal bond interest that pays very low, but that is tax-free. Passive income, as you invest more and as you go through your career, you may have some passive income which you do not actively participate, like a limited partnership or an LLC. You may be an LLC member where you're just investing. You may be doing some crowdfunding. Okay, same thing. You're really not working the business, but you're receiving an income stream from that. That's going to be taxable. And of course, anything else in here. I mean, again, the IRS and the government want to pretty much look at alimony awards, lottery winnings, prizes, yes, gambling over a certain amount. It used to be $1,500 if you're ever at the horse races. I know in Louisiana where they have their horse racing, any winner over $1,500, there is taxes taken out. Like if you hit a big daily double or something like that, and you won, they're there to celebrate your victory by taking out taxes. Scholarships could also possibly put in here, and that is once your scholarship amount. Some of our students are getting very great transfer scholarships to other universities. In fact, they're getting a good amount to where their tuition, fees, books, rent, food, everything is covered, and they're getting more than that. So if there's an excess, the government would like to celebrate your scholarship by taking some of it back. Okay, so what types of income are you going to have in life? We just looked at that. So what things could be excluded? All right, let's see. A portion of foreign earned income up to $100,000. So if you have the opportunity to work abroad and you have a foreign income as well, this is something you definitely need some great tax advice from a tax attorney. But you can basically exclude up to $100,000. That's nice. Exclusions can be tax exempt income. Again, we talked about municipal bonds just in city and state bonds that are municipal. They're not paying a whole lot unless you had some bonds that have not been retired and they were issued in the 1990s. Again, maybe your parents or grandparents. That is tax-free interest, and so that's exempt from even putting it on your W-4 form. Excuse me, your 1040 income that's taxed later. You can have some of your income called tax deferral, all right? And that means you are not getting paid. It's going into an escrow account. There will come a time when you utilize that income. So for some people who are making a really good income and you say, I don't need all of this, can we make this into a tax deferred area and have it later? When we look at types of income, there's also some income that could be excluded from your gross income. All right. If you ever get a chance to work for another country and you have a foreign government earned, which means in today's world that could be basically working here, but working for maybe another foreign company or corporation, you do get up to $100,000 exempted or excluded from putting that into your gross income. Now that is a subject you would definitely need to have some professional tax advice, but that is out there. So something to think about. Other exclusions of tax-exempt income not subject to federal income tax. Again, this is where high-powered tax attorneys can do a lot of good for you if you're in a very high income bracket. But if you have municipal bonds for state, county, and city bonds, sometimes Tarrant County College also can take advantage of that. But your municipal bonds are non-taxable. They don't pay a lot of interest. However, if you or your parents or grandparents have some municipal bonds from the 90s that were not yet retired, most cities that bought them have paid them off. But if they didn't, those could be at a pretty good interest rate, like 5, 6, 7%, and that's tax exempt. So hang on to those. And of course, income to be taxed later. You can tax defer some of your income. If you get to a point in life where you're making a very good income and you say to yourself, I really don't need all of it right now, I could put it into an escrow account, have my organization put it into an escrow and call it tax deferred, and then I can have access to it later. When I have access to it, then I pay the income tax. However, that is an option, but we're pretty much at the lowest income taxes we've seen in this country in its history. So there's always the risk that the income tax rates rise, and then you go get that money and you're paying a higher income tax. So be careful of that. Again, you definitely want some professional advice. Also, on some IRAs, a traditional IRA, that is tax deferred income. Your retirement plans are tax deferred. So you get a deduction off that, and then when you go to retirement and you need that income, then it becomes ordinary income and is taxed. So again, the adjustments to your gross income. So when you get your final W-2, okay, and you see your gross income, you're really not going to pay tax on that total. You're going to see a lot of different adjustments and then itemized or standard deductions. So your AGI can have reduced. AGI is adjusted gross income. So before a few adjustments are made here, again, a traditional IRA or your KEO, which is something, your 401k, retirement plan. So if you look at your W-2, you may see you're invested in a retirement plan. If they took out $8,000 for retirement, that comes off your adjusted gross income. Okay, so If you paid a penalty because you took out money from your IRA early, there's a very big penalty for that, and that's before 59 and a half years old. You take out your IRA on a traditional IRA, you'll pay an interest, you'll pay 10% penalty and taxes. The penalty, you get a little bit back from if it's a $10,000, that's an adjustment to your income. Alimony payments, any other types of tax sheltering, again, this is where somebody who is a tax professional can guide you in those directions. Of course, you need to be making quite a bit of income to be able to take advantage of that, but it's called tax shelters, all right, or capital gains losses, and that is beyond the scope of what we're trying to talk about. Computing your income, your taxable income. So remember, once you see that your gross income, okay, it's going to be subtracted, all right, from your AGI. It goes down from your deductions, the deferments like the IRA and the retirement. Then it can go down one more level, and that is either your expenses, the itemized deductions, or a standard deduction. Now, during this administration, the Trump administration has really increased the standard deductions. However, that means most people cannot itemize anymore. It's very difficult to itemize your deductions. So let's look at this. You had $81,000 of gross income. That's your wages, everything you put in there. Everything that was income was right there. Okay. Now you had a retirement plan, so they took off $4,500. So now your adjusted gross income is $76,550. Itemized deductions or the standard. For a married filing jointly, you get a $24,000 standard deduction. So now your taxable income is $52,000. This is where the tax rate is taken. Okay, so there was your top, and we had some deductions, and there we go. All right. What about a tax credit? Now, tax credits come at the very end. Once we have found everything, that 52, that last number, then we can see, and again, hopefully you're using some sort of a financial software to do this for you, like H&R Block or TurboTax or something like that. A tax credit is beautiful because this is not a deduction. This just offsets any taxes that you may owe. All right? So, let's look at the difference between a credit and a deduction. A $100 tax credit reduces your taxes by $100. A $100 tax deduction reduces it by $25. All right, if you're in the 25% bracket. So basically, it's the deduction multiplied by your tax rate, and that's what you get. So you can see tax credits are great. There's not a lot of them, but again, with some really careful planning, you may be able to find some. Let's look at some. Foreign taxes, all right? Any foreign taxes that you would pay are going to offset with a credit. You're going to need a good tax expert to figure that out. Now here's something. Child and dependent care taxes. If you have children and you are having someone watch them while you're at work for child care, make sure that you are getting receipts for that. Because once you get the receipts, then you're going to put that on your taxes, and they're going to receive a notice from the IRS as well. But that, up to a certain amount of money, can be a certain amount of income. That is a tax credit. And sometimes we're paying somebody in the neighborhood or someone we know, and you may miss that tax credit. So especially if you're going through an organized corporation, that's doing your child care, make sure you save that. Okay. The government is giving a tax credit for retirement contributions if you are in a certain income bracket, and I believe it's under $70,000. Well, it's under 70, maybe even less than that. But look at that online, because that is huge, my friends. So it's called a catch-up is what it's trying to do. We're trying to catch up to savings for retirement, because as we're going to go on, we're going to see that most Americans are saving nothing for retirement. This gives you an extra incentive depending on your income. And so we've got other things right in here. As you're going to class, this is a tax credit. There's the American Opportunity and Lifetime Learning. So if you are in your first 4 years, or if you have children that are about to go to college, you get to deduct expenses and tuition. Okay, you do not, room and board does not count, and it gives you up to, I believe, a maximum of $2,000. So when I did that for my daughter, so take advantage of that. If you say, well, what about if it's just for me? Then you get the lifetime learning credit, which is a little bit less, but it's a credit, still a credit. So look at that. Mortgage interest, again, some of this happens to do with a little bit of a lower income, trying to get everybody into a house. Energy savings, these may be phasing out, but for those of you who put on solar power and did a lot of insulation, you get a certain tax credit back. Again, these may be phasing out right now. Taking care of the elderly and disabled, that is a tax credit in there. So, again, alternative motor vehicle, that is those electric cars or natural gas. So these are some great things to research, my friends. What can you take advantage to get yourself a tax credit? That's amazing. Payments and deadlines. The IRS is an organization you just don't want to mess with. Okay. I know of a lot of people who are self-employed. I have known over my past work experiences. And people say, you know what, I'm just going to get paid in cash and not mess with taxes. That's a slippery slope, my friends, because there's a lot of penalties, and the IRS has a way of if they find out, if someone turns you in. So, you know what, be careful. Don't do that. There's withholding your tax payments, and there's estimated payments. Most of us who are getting an income every month, we have money taken out. Now, under the Trump tax laws that came out recently, you got to keep more of your monthly income or weekly income. We'll say it's monthly. And then at the end of the year, a lot of people, a majority, like 50% of Americans in a pretty good tax bracket, had to pay more at the end because they weren't withholding enough income. So we can look at that, all right, and how to fix that. Also, if you are self-employed, or if you have just a tremendous amount of investment income, you make your estimated payments, and those are every quarter on the 15th. So that way you reduce your taxes versus paying one time of the year. Okay, so there's our deadlines. We know it's April 15th for most years. In 2020, it is now July 15th. These are some automatic extensions to file the return. This doesn't mean you don't have to pay. It just gives you an extension to pay it back in October. And again, because of what we're dealing with right now in the COVID-19, these dates may be extended, but this is where you definitely need to have some help. Failure to pay your taxes, the IRS can garnish wages. They can put liens on property. Like I say, they're just something that we do not want to be on the bad side, because 25% penalty in addition to taxes owed. If you ever get in this situation, my friends, I know it's a lot of anxiety. You need a tax lawyer and someone who deals with the IRS, okay? Because there's a lot of negotiation that can really happen and can work out to your benefit. The government does not want to put you in jail for this. They don't, because they want you to earn money and pay money into the system. So, anytime something like this happens, or if someone's doing your accounting and they made a mistake or committed fraud, you need to have someone to bail you out of that situation. There's your W-4 form. I put this in here because you may want to update that, and you can update it year-round. Under the new tax laws, I found myself not enough was withheld, and I owed a pretty good chunk at the end of the year. And so what I did, I immediately got my W-4 form. In days gone past, we used to have exemptions, and exemptions was for you, your children, your spouse, partner. Now those exemptions are gone. So right now it does not behoove, which is an old word, anyone. You just put single. right now, because that's what you are. And certainly if you are single, you put single, you can literally have more money taken out as well. So both my wife and I, we put single, and even had more taken out per month. That way at the end of the year we actually got something back, because it's not fun when you see $2,000 plus taxes owed after you paid all the other taxes. So look at this again. You can do it. I've known some colleagues who let the first of the year go by. Then in June they ask for more money to be held out, and then in September they ask for more money to be held out. I don't know why, but that's how they did it. So maybe you need to look at that W-4. If you owed money anytime at the when you filed your taxes, and if it was a considerable amount, I mean, if it's a couple $100, big deal. But if it's in the thousands, you definitely want to update your W-4 form or get some more tax credits. And again, there's your W-2. Most everyone is doing this online. You may have it mailed to you. I did find something out that sometimes your address may be different, and that's not going to change anything. Don't worry about that, because maybe you've moved, you don't have to have a new W-4 form, or your organization got your address. Sometimes they put it as their address. That's not going to hurt anything. Who must file? The government would love everyone to file. Single, there's your statuses. Divorced or legally separate. Married, filing joint. This gets you the biggest deductions right in here. Okay? Now, when two people come together, there may be a marriage penalty. When I say two people come together, that's a real good statement, isn't it? If you're a little bit older and you have a lot of assets together, usually retired people, it hurts, because maybe they've lost a spouse, and they find new companions, and it doesn't help them to be married because of certain situations. Okay, but this generally gets you the biggest return. Married filing separate, that happens a lot. That's just two people who don't want to have, they want to keep their own finances. And then you got a head of household. That's if you're single and you are basically caring for others. You get a little better tax return. A better amount of deductions. And then you have a widower. So we're covering the gamut. The government would love everybody, to hit that. Once you have an income, they want you to file. So there's what we look at: your status, your income, your adjustments, your computation, other taxes. And then make sure you sign your return. And of course, you can sign that digitally now with just putting in a PIN number. And then most Americans do receive, and I say most, about 70% and up, do receive a refund every year. And what if you didn't get your refund? What if you didn't file? You're still owed that refund, but there is a statute of limitations, and the government doesn't give you that long. You only have a couple years to get that going, or they're going to keep the money. So, for 70% of Americans, it is the right, you want to get your taxes filed and on time and get that return as soon as you possibly can, because it is your money. Now, this will bring fear to most everybody. What if your return is audited? Just looking at it, I'm already in a cold sweat. It's not that much. It doesn't happen all the time. It is basically the IRS needs to ask you some questions. Okay, 1% of all tax filers are audited. Okay, if you claim very large or very strange deductions, okay, unless you have that tax attorney ready for you, because they're a tax attorney, and say, hey, I don't care. I don't care. I can, as long as I can beat him in court. That's all I care about. But for the most of us, we're not going to be able to do that. But if we do something very strange, that's a likelihood. I want to make this very clear. All correspondences by the IRS are initiated by the U.S. Mail Service. When you get these fake phone calls that your return is audited, hi, we're from the IRS and you owe us money, hey, hang up, block the call, because you can never report them because their numbers are bogus. The IRS, Social Security, the federal government does not contact you by the phone for the first time. Okay, it's always by mail, and it's usually certified mail. So that's when you open it up and they say, hey, we've seen something. Would you call this number? 99% of the time, you can write a letter back. Okay, you can write the letter back and say, this was the reason why. and then they'll look at it, and then they'll contact you again if they feel that the answer was not sufficient. Again, most are for minor questions. Sometimes you've just written the wrong check. You owed money and it was $500 and $500.20, and you wrote $52 because you got the numbers mixed up. You may have transposed it. I've seen that happens more than you think. So, an office audit takes place at an IRS office. Okay. Field audit, yikes! You don't want a field audit happening, because those are Treasury agents that carry sidearms, and they generally are not there to discuss a whole lot. They're there to take and seize property. So, you'd better, that ever happens, yes, that is serious, serious business. You have the rights, you have including time to prepare for the audit. You have rights to your accountant or attorney to represent you as well. So, but I see this all the time right in here. So just hang that phone up, never return their call, and don't be afraid by those phone calls first from the IRS, because they're completely bogus. It's going to be by mail your first time. Anything we can do to plan? Yeah, absolutely. The legal thing is tax avoidance. All right, legitimately look at deductions. Here's something for this new year, for out the 2020 and 2021. Religious and charitable contributions were always a part of itemizing your taxes. Well, I did read, because of the pandemics that we are in and that will be in, unfortunately, for some time, you can deduct, I believe, $250. These come right off your taxes. They're not part of itemization. So there's something. If you have a favorite charity, if you have a favorite organization, and you weren't able to itemize, you still get a small deduction. And so it helps everybody out. Trying to help out a lot of nonprofits right now that are really struggling, and will for the next few years. Financial decisions related to purchasing, investment, retirement. Again, when to make your IRA deductions. As long as you make those before the tax deadline, you're good for the previous year. Okay. Things you don't want to do. You don't want to do tax evasion. This, not reporting your income. Mistakes are made, but when it's fraud, it's dealt with very seriously. To minimize your taxes owed, again, all right, you may accelerate deductions, especially if you may have a lower tax rate in the next year. All right. Delay the receipt of income. That's a possibility that we did talk about. If you're getting a tremendous amount of income and you don't want to pay all those taxes, usually when your organizations pay you a nice bonus, they'll pay it. Let's say it's 2020, they'll pay your bonus in 2021. That way, that income won't be reported until the next year. It's still going to catch up with you. Delay your deductions, okay, if you expect to have a higher tax rate next year, and accelerate the receipt of income. Again, these are some items that you want to read through the book and get some better tax advice to really take advantage. Real quickly here, we're going to discuss much more of the traditional and the Roth IRA and our investments and in our retirement planning. But I want you to know right in here, there's a traditional IRA, and that is the tax deduction. So you put $5,000 in this year into your traditional IRA. In your taxes, when you file them, all right, for the next year, well, you know what I mean, you're going to file them next year, you get to take $5,000 off your adjusted gross income. So that lowers your taxes. Okay. At some point, you're going to retire. That money becomes ordinary income when you reach 59 and a half years old. Just like our Jimmy and Jerry right in there, we have that illustration of using that income that they saved early in life, and then they had that nice retirement. Well, if you had $1 million, let's just say, it's a nice big round number, in that traditional IRA, and you needed it when you turned 60 years old, and you said, you know what, I need to take out $500,000 because I'm going to buy my lake house. It's going to be fantastic. That becomes ordinary income. That will put you into the highest income tax bracket, which is anywhere between, let's say it's 30%. So now 30% of that, $150,000, is now going to come out of taxes. If you invest in a Roth IRA, it is tax-free for life of the investment, as long as you've had it in at least 5 years. It is not tax deferred. You put $5,000 into the tax, and this is a Roth IRA. You do not get that deduction each year. At the end, let's say that you have that same $1 million in there. You go to take out that $500,000 or $100,000, whatever the amount, for that lake house, that retirement home. It is completely tax-free. Which one do you want to use? Now, there are rules. If you are a single taxpayer or married filing single as well, or head of household, again, it depends on the how you're filing, and you make a lot of money, you make like $125,000, then you can only use the traditional IRA. So do it. If you're filing joint, married, you cannot have more. And again, please, you got to look at these numbers because they change. Let's say $190,000. But if you're so you cannot get to the Roth. If you can do the Roth, always do the Roth. This is not a hard question. You want tax-free money. Traditional IRAs have limitations. When you age and you get older, when you turn 70, you must start taking withdrawals from the traditional IRA. The government basically wants that tax, the tax savings that you got earlier in life. They're going to want it back. The Roth IRA can go in perpetuity, and it can be gifted down. So if you can do the Roth, my friends, this is huge. This is a 1,000-pound dog. If we were in Arkansas, we'd say it's so fantastic. So please, those of you who have time, all right, and the time of money on your side, that's what we want to invest in. These are other parts right in here that can come off your tax, but they're tax deferrals. This is tax free, and there's nothing better than being tax free. Quick wrap up. I think you can see how important tax planning is to our financial plan. You definitely need to seek the help. Again, as Socrates would say, the key to wisdom is to understand what you do not already know. So we've scratched the surface. There's a lot more learning to do in here. Read that chapter 3. But hopefully you have a better idea of tax deferrals and tax credits. These are questions that we're trying to answer for Frank. And how to survive that tax audit. Again, read through the book. You do have rights. And remember, the IRS corresponds through mail. Don't believe these terrible, fraudulent phone calls that are going around all year round. All right, that wraps up chapter 4. Answer those questions, and we're on to chapter 5 next.